Well, there's a look at the stock performance for goeasy over the last 3 months. The company just reported quarterly results after the bell last night, and the profit story continues to improve there. The alternative lender also keeping tabs on what's happening in Ottawa. We were covering the company recently, just trying to figure out the story on caps surrounding lending rates. That's something that the company has plenty of opinions on. Investors have had a lot of opinions on the business, though, because when you look at the TSX financials, this is actually the best performing stock over the last year. Want to get a little bit more perspective on what's happening with the business. Joining us here in studio is Jason Mullins, the president and CEO of goeasy. Nice to see you, Jason. Thanks for joining us.
Thanks for having me.
Okay, so as an alternative lender, just remind our audience how the business works, and you were pretty busy, actually, over the last 3 months.
Yeah, so for a bit of background, there's just over 30 million Canadians in Canada that have an active credit score, and about 9 million of them are deemed non-prime. So based on their credit score, they're generally unable to access credit from one of the main banks. So they would then turn to a company like ours to access a variety of sources of credit.
And then in an environment like this, where all of a sudden interest rates go up very quickly, how did that ultimately impact the amount of volume with your business?
Yeah, so we're definitely noticing an increase in demand. Just in the most recent quarter, applications for credit are up 40% year on year. So I think that's a signal of not only consumers in this environment needing to rely more on credit, but also as banks tighten credit tolerance, that means more consumers are going to have to turn to lenders like ourselves.
And just for a little extra context, too, when people are coming to you for lending and maybe moving away or being shifted away from a traditional bank, what kind of loans are we talking about here?
Yeah, so we offer a very wide variety of loans, everything from a personal loan, which would just be an installment loan in the form of cash. We do automotive financing, so to help consumers purchase typically used vehicles. We also help purchase everyday goods, furniture, appliances, electronics, even dental work if someone doesn't have the insurance coverage. So it's a really wide variety of everyday household needs.
Now, as an alternative lender, when the demand is growing, what's the balancing act for you as a place that increasingly consumers are coming to?
Yeah, the most important thing for a lender is to make sure we're being very careful and selective with the loans that we issue. We've got to make sure we're setting the customer up for success. So while applications for credit were up 40% this past quarter, we only wrote 13% more loans. And that's really an indication of us just being extra cautious and careful about making sure we're only giving out the loans that we know are going to allow the customer to repay.
Now, seeing everything that you're seeing right now, what would be your assessment of the economy? You know, people are constantly wondering how long interest rates are going to stay at their current level. What's your assessment of what's happening here in Canada right now?
Yeah, the consumer's definitely under a level of stress. I think we've seen the economy has been fairly resilient in large part because wage growth today still is exceeding inflation levels as a result of inflation having come down. The economy is, of course, being fueled by new Canadians and immigration. But I think the consumer generally is under a level of stress. And it's just that much more important for lenders like ourselves to just be extra careful and extra selective with the loans that we write.
The goeasy story was getting some attention recently with the federal budget because a lot of people were wondering about the specific caps on lending rates. It actually seemed like some on Bay Street were relieved by what played out. But can you just walk us through whatever the message to Ottawa felt like on your end?
Yeah, so essentially the federal government is planning to lower the maximum allowable interest rate that companies like ours can charge. The unintended consequences of that is that there's a lot of consumers that now will lose access to licensed regulated credit. Every lender would price a loan according to risk, just like an insurance company would price premiums. And if by regulation you force down the rate that a lender can charge, inevitably certain customers, based on their risk profile, are going to now get declined for credit. What we've seen is that that's actually been so disruptive to the market, specifically smaller scale companies, earlier stage companies, that it's actually pushed even more demand to companies like goeasy and those that have scale.
What would be your suggestion on making the market work in a more efficient and effective way for getting people access to credit?
Yeah, so we believe strongly in the existence of regulations. They're very, very important. It's important that there's regulations around disclosure, transparency, the way lenders treat customers. But ultimately, a government has to choose between access and price. You can't really have both. And under the existing regulations, we think they're very fair as they exist today, and it allows the most broad set of consumers possible to get access to credit.
Okay, well, as we sit here, obviously, overall, you're very busy with the business. Investors have been taking note. I highlighted that within the financials group, and we talk about the big banks all the time, goeasy stock prices had better performance over the last year. It's a very well-liked stock on Bay Street, and we're increasingly getting calls around the business. What are the most common questions you're getting from investors these days?
Yeah, so generally it's questions about what is the growth outlook for the business. We expect that we'll grow our consumer loan portfolio from about $3.8 billion today to about $4.5 billion by the end of this year and about $6 billion by the end of 2026. So we've got a pretty robust growth outlook. And then the second question is always around credit performance. How are we making sure that we're managing credit in a disciplined and prudent manner that we can maintain a steady loss ratio?
And are you making any assumptions? I assume you are making certain calculations, but in terms of what the interest rate environment will look like as that overall loan book grows over the next couple of years?
Yeah, we essentially buy a series of economic forecasts and we weight those economic forecasts. Today, we're still assuming a mild to moderate recession. So we're taking a more conservative view that while rates will gradually come down, unemployment will continue to rise from today's 6.1 to somewhere in the high sixes. So that's just a slightly more conservative view based on what we're seeing in the economy today.
Okay, and just finally, just coming back to the investor story, usually with the financials here in Canada, investors are always curious about the dividend story. We do a segment called The List, where we screen companies that have seen the most notable dividend growth. And over the last 5 years, you guys are right there. It's a very exclusive list of companies that have grown their dividends as much as you have. But also Bloomberg data is projecting that your dividend will continue to grow. Can you explain to our audience that's very interested in dividends how you're approaching that going forward?
Yeah, it's pretty straightforward. We've been compounding earnings growth at around 20 to 25% for the last 5 to 10 years. We believe that we can continue to compound growth at those levels going forward. And we have a payout ratio of about 1/3 of the prior year's trailing earnings. And so as a result, for the last 10 years, every year we've consistently increased the dividend, and our intention is to continue to do that for investors.